Today, the Fed ain't done lifting rates yet. Hello again, it's Martin North from Digital Finance Analytics. Well, latest post covering finance and news with a distinctively Australian flavour. Well, the Federal Reserve will likely need to raise interest rates more than expected in response to recent strong data, and is prepared to move in larger steps if the totality of incoming information suggests tougher measures are needed to control inflation. Fed Chair Jerome Powell told US lawmakers on Tuesday. The latest economic data has come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated, Powell said, for a hearing before the Senate Banking Committee.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
There is little sign of disinflation thus far in the category of core services, excluding housing, which accounts for more than half of core consumer expenditures. To restore price stability, we will need to see lower inflation in this sector, and there will very likely be some softening in labour market conditions, he said. About 67% of traders now expect the Fed to deliver a 50 basis point rate hike at its March 21-22 meeting, compared with just 24% prior to Powell's remarks. And the US Central Bank has been hiking rates aggressively, of course, and shedding bonds it owns to counter the highest level of US inflation seen in decades. Disruptions tied to the coronavirus pandemic, coupled with very strong levels of demand, in part driven by government stimulus, have worked together to drive up inflation after many years of price pressures falling persistently short of the Fed's 2% target, which was first adopted in 2012 after years of existing in some sort of de facto status. The Fed's efforts to temper inflation have taken the benchmark overnight interest rate from near zero levels a year ago to the current 4.5 to 4.75%. And Powell noted on Tuesday that the persistence of high inflation amid broader economic strength could cause the central bank to quicken the pace of future rate rises and go further with them over time. As the Fed has acted on inflation, it's been dogged by fears that its rate increases will push the economy into recession and drive up unemployment by an intolerable amount. That's caused some critics to say that the Fed may want to shift its inflation target up from 2%, making it both easier to reach a desired level while minimizing risks to the broader economy. But Fed officials have repeatedly pushed back against the idea. They argue that doing so now would impair their credibility with markets and the broader public, who would in the future expect the central bank to change its inflation target based on the expediency of whatever challenges it was facing at the time. Policymakers also believe that allowing inflation over 2% would help embed high price pressures into the economy and make it much harder to lower inflation in the future. In fact, Powell said on Tuesday that the US Central Bank's decade-old 2% inflation target has in past years been a key factor in keeping inflation low, and holding that target at the current level should help in policymakers' efforts to lower high price pressures. We think it's really important that we do stick to a 2% inflation target and not consider changing it, Powell said. The 2% inflation target really anchors inflation because the modern belief is that people's expectations about inflation actually have a real effect on inflation. If you expect inflation to go up to 5%, then it will, he said. Other major central banks also target 2% inflation, and many have questioned why officials have gravitated to that number rather than something like 0, which in theory is the level that most aligns with unchanged inflation pressures. New Zealand Central Bank was the first to try our 2% target, and central bankers have countered that 2% gives them a cushion. It's not so high as to amount to noticeable overall price gains, and it helps central banks avoid outright price declines, which most economists consider to be damaging to an economy's health. You might say 0% inflation, stable prices, no inflation. Well, that makes sense, New York Fed President John Williams said on January the 19th. That said, we know that if you try to push inflation too low, it runs the risk of pushing a central bank's target rate to 0 as well, which makes it harder to conduct monetary policy, he said. The 2% Goldilocks answer, if you will, is really about balancing price stability goals and maximum employment goals, taking into account all the factors that influence the interplay between the two, Williams said. Some of the questions to Powell were actually very pointed. For example, the impact on households from the higher unemployment expected ahead.
I also sit on Senate Finance. Right across the way, we were talking about affordable housing. I think for purposes of so many of us across the country, including in Nevada, when we talk about affordable housing, it's also about workforce housing. It's about making sure families that are working so hard have an opportunity to keep a roof over their head. Right now in Nevada, if you're making minimum wage, you have to work 75 hours a week just to be able to afford housing. And so I want to talk to you about this. I was distressed to see in the report that that activity in the housing sector has contracted as a result of the elevated mortgage rate, and you've been talking about that. I often hear from Nevadans who say, I don't know if I'm ever going to own a home, and many feel resigned being stuck in a cycle of renting. So, Chairman, how do the Federal Reserve economists and leaders think about the balance between keeping interest rates low to spur that affordable home building and home buying while addressing inflation?
We have a dual mandate from Congress, as you well know, which is maximum employment and price stability. And that's really what we take into account. We don't, and of course, interest-sensitive spending is the thing that gets the most support when we cut rates and the thing that is most affected when we raise rates. And that means housing to a significant extent. That's not a choice that we make. That's just the way it works. And we only have really one tool, which is monetary policy. So, you know, we don't really try to use our tools to affect broader housing policy, but really just to achieve our statutory goals.
It happens to just unfortunately be in effect as you try to achieve your statutory goal. Is that?
Yes.
Yeah.
Yes.
And so I want to have you have the opportunity to address Senator Warren's conversation with you earlier about the tools that you have and the impact it has on causing potentially more people to be unemployed, and this obviously has an impact on their ability to afford homes as well. Can you address that?
I'd be glad to. I want to be clear that we do not seek and we don't believe we need to have a very significant downturn in the labor market. And it's not just hope. I think if you look at the situation in the labor market, you've got all these job openings, and in principle, you could reduce the job openings without seeing a really significant increase in unemployment. Also, you're starting from such a strong labor market. It seems as though you're a long way away from anything that looks like a recession, just looking at the labor market by itself. So, honestly, we don't know that we need that there will need to be a really significant downturn. Other business cycles had quite different backstories than this one, and we're going to have to find out whether that matters or not. But I do think that I've said all along, and my colleagues and I have too, that we believe that we can. There's a path to restoring 2% inflation with less significant effects on the labor market than have typically been seen in downturns.
And there was also discussions of alternative strategies beyond the blunt interest rate lever.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking
infrequent.
at the numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this.
There have been 12 times that we've seen a 1 point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising, and then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that, but I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families. And if you're not going to lead that charge, we need someone at the Fed who will.
The market reaction was quite interesting, with US stocks sold off, Treasury yields rose, and the dollar extended a gain after Powell's comments, which were his first since inflation unexpectedly jumped in January, and the US government reported an unusually large increase in payroll jobs for that month. The S&P 500 lost 0.88% to 4,012, from just around flat just before Powell's remarks were released, and the US 10-year Treasury note after the remarks lifted up to 3.999%, up from where it was before he spoke. And the euro extended a loss and was off about 0.8% as the dollar index rose. The 2-year Treasury yield on Tuesday soared to its highest level since 2007 as the remarks ramped up bets on a return to aggressive rate hikes at the central bank's March meeting. The 2-year Treasury yield, which is the most sensitive to rate hikes, jumped 12 basis points to 5.021%. That's the highest level since 2007, and the move rattled sentiment on risk assets, keeping the S&P 500 deep in the red. The hawkish repricing comes just days ahead of the monthly non-farm payrolls that could all but cement expectations for a bigger rate hike in March, should the report surprise to the upside. Chair Powell's prepared remarks for his semi-annual testimony opened the door to a return to 50 basis point hikes at the March meeting if the incoming data flow warrants it, Morgan Stanley said in the note. Upside surprises to Friday's payroll report could drive a faster and longer tightening cycle. Quincy Crosby, chief global strategist at LPL Financial, said coming into the meeting, it was almost a 30% probability priced in by the futures market for a 50 basis point rate hike. Powell made it clear that the Fed would react accordingly if the data suggested inflation continues to move in the wrong direction. And you can see the reaction in the equity market. And at this stage, they don't know what the CPI is going to indicate, nor the PPI. But Powell was matter of fact in that statement. It was very clear to the market that the Fed is not going to equivocate in terms of the data that suggests inflation continues to climb higher or remain sticky. And Chris Zaccarelli, the chief investment officer at Independent Advisor Alliance, said clearly the stock and bond markets are reacting to Powell's talking points, and specifically the idea that interest rates are likely to be higher than previously anticipated. Powell is explicitly talking about a higher target for interest rates. This is something that the market has been talking about, but obviously hasn't been fully priced in. The idea that rates are going to be higher for longer is going to be a headwind for stocks and bonds. A lot of people have been expecting this would be the case, but hearing it directly from Powell is a little different to inferring it from the data. For the market to fall apart in a bigger way, we'd need to see a deterioration in fundamentals. So that would be the economy potentially going into recession or corporate profits dropping off a cliff. And so far, we haven't seen that, so I don't expect the market to completely fall apart, but I do think this is going to set a more risk-off tone than we saw in January. And Scott Ladner, chief investment officer at Horizon Investment, said this market reaction is a little bit surprising because it is the most obvious conclusion from everything we've seen over the last month. This knee-jerk movement lower in equities probably will reverse back to flat. 6% terminal rates will be a little higher than is likely. Probably they will settle into the 5 and 5.5 or 5 3/4 range. A 50 basis point hike at the next meeting is possible, but it is going to be dependent on the payrolls not slowing down and CPI numbers showing that the disinflation progress we've made is stalling. And Michael Brown, the market analyst from TREDX in London, said a surprisingly hawkish statement from the Fed Chair Powell this afternoon, putting an option of a 50 basis point hike on the table for March, while also showing disappointment about lack of progress made on inflation thus far. This serves to markets as another reminder that the Fed is resolute in their desire to tighten financial conditions and keep them tight. Unsurprisingly, the dollar has gained, and both bonds and stocks lurched lower. Despite the hawkish repricing, Powell again noted that the peak rate is likely to be higher than expected, putting bond bears and dollar bulls back in the driving seat. With a hot non-farm payroll print on Friday likely to see calls for a 6% terminal rate increase. And Robert Pavlik, senior portfolio manager with Dakota Wealth, said the focus of the Fed is trying to get inflation down to 2%. Powell reiterated what we already know, but he's not saying anything that's dovish, and the market is feeling a bit nervous about the Fed's next move. How many rate hikes are coming, and how long are they going to keep rates up? I prefer just one more 25 basis point hike, but probably we're going to get 3 25 basis point hikes. And they are just sort of reiterating that the economy is slowing, price stability is difficult to achieve, inflation is sticky and not moving in the correct direction. And the Fed is going to continue with their policy of raising rates. So it's just what the market doesn't want. I don't think it makes anybody feel that a recession is going to be more dramatic or deeper than what they already feared. Those concerns are already out there. Well, my view is this, that once again, the Fed has underscored higher rates for longer. The markets have not fully priced in that particular scenario, in my view. And given everything we know about the way that economies work, it is likely that the stock markets are way overvalued. And of course, the bonds will continue to rise higher too, which makes investing quite interesting at the moment, to put it mildly. So anybody who thinks that the Fed is going to pivot soon and that we're going to go back to low interest rate environments again, I think are smoking that hopium. And if you listen to the Fed and listen to Powell, he's as clear as he can be. But still, many in the markets have their fingers in their ears. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.